our host, Alan Porter. Alan, what's going on, man? How are you?
How you doing, Neil? It's a great day here in North Carolina.
Absolutely. And we're going to talk about a really interesting topic, how millionaires turn taxes into wealth, the advanced tax strategies the rich actually use. And Alan, taxes are our biggest expense. And here's how millionaires legally turn it into fuel for more wealth. I'm really excited about learning about this. Why do you say taxes are the biggest threat to millionaires' wealth?
Well, Neil, like people don't understand. I always ask people, I said, what is your number one expense? And they always come back, well, my company, my wife, my house, or whatever. No, your biggest expense is taxes. And they just need to know how to legally turn them into fuel for more wealth. But because the more you earn, the more the IRS takes, okay? From high net worth families, taxes can erode 35 to over 50% of their wealth over time. Without planning, you lose more to taxes and fees than in market losses. And like I said, you've got to have a plan for this.
What are the top tax traps wealthy individuals fall into?
Well, a lot of wealthy individuals, they can't put into a 401k, but a lot of people overfund their 401ks, relying too heavily on tax deferred accounts and ignoring state taxes and failing to use tax advantage vehicles like cash value life insurance. I mean, this is crazy. Why people don't understand this. It's not about how much you have in assets in retirement. It's about distribution of your assets.
And you're able to set those things up for people, Alan. We've talked about that countless times. And you're right. It's they overfund all these different markets. So they go play the stock market. They do all these things, and they're not conservative to understand. It's not like, a game. At the end of the day, you got to play the right game and win the game, not go and risk the game so that you have a chance of losing. While you work with your team of professionals, Alan, you're not going to have the risk that playing it yourself.
Well, absolutely, Neil. Because when I show people, I want to show them how to protect themselves from the risk in retirement, such as sequence of returns risk, which very few people know about. And I don't know why, because these fee-based advisors are supposed to be fiduciaries. Now, I'm a certified financial fiduciary, but sequence of returns risk will decimate people's retirement. In short, basically what it is, let's say you're 65 and you go to take out a 4% distribution rate, which they said is a safe distribution rate to last for 30 years. And that's indexed for inflation at 3%. But all of my retirement programs, you go to age 120. But let's say you had that $1 million, you took that $40,000 out. The market goes down 10% the first year. So now you've got $900,000 minus the $40,000 you took out, minus the fees you paid that financial advisor, whether you make money or not. And then what happens if 2008 happens again in the next 2 to 3 years, where you lose 38 to 52%? You're going to be out of money in the fifth and ninth year. And basically what it is, if you have a loss in the market if you have a loss in the market in the last 2 to 3 years of a 10 or 20 year period, as compared to the first 2 to 3 years of a 10 or 20 year period, you're going to be out of money in the fifth and ninth year. People don't know about this. That's just one of the massive risks in retirement that a stock portfolio only compounds.
What tax strategies do the wealthy actually use to legally reduce taxes?
Well, one of the smartest ones is a strategic Roth conversion. Now, there's many things out there that I don't agree with on some of these Roth conversions, but another great, because I've got 8 of these policies myself, property constructed cash value life insurance. Because as far as I'm concerned, and people that are educated, advisors that are educated in this, it is the best tax code approved, tax-free retirement system available today that mitigates or eliminates all the risk in retirement. Like I said, that a stock portfolio, bond portfolio, money market funds, mutual funds, CDs, they only compound. The number one fear of retirement, Bill, is running out of money before you run out of life. None of those financial vehicles, like I just said, the 401 stock portfolio, any of those, they can't eliminate. They can compound it, but longevity risk is another one, and it's a risk multiplier. And one of the things that people don't understand, Neil, is the risk of long-term care. I can mitigate or eliminate long-term care risk for pennies on the dollar with tax-free money. And right now, long-term care will affect 70% of all Americans in the United States, and people are not prepared for it. Right now, it costs between $50,000 to $200,000 a year and goes up by 6% every year.
It's crazy.
You can go charitable trust, deferred compensation plans. I do that for a lot of people. But then annuity income laddering for lower taxable income. Because understand this, you got to have guaranteed income in retirement. And I'll give you a perfect example. Let's say that you have that $1 million, and I've said this many times. You have that $1 million in a stock portfolio at a 4% distribution rate. That's $40,000. Well, you need only to have approximately $650,000 of that $1 million into the fixed indexed annuity when properly structured to give you the same $40,000 a year. That's guaranteed for the rest of your life. I don't care if you live to age 120. That accumulation value goes to zero at say 85 or something like that. You're still obligated. The insurance company is still obligated by contract to pay you until age 120 or until you pass away. It can be set up with you and your spouse. It's 0.5% less, but they're insuring 2 lives. And get a load of this, Neil, where you're guaranteed by contract never to have a loss during a market downturn. But we use crediting strategies like an indexing strategy, such as the Barclays Dynamic Balance Index, the Euro Index, just all kinds, the S&P 500 Index. There's about 176 of them out there. And every time one of these indexes goes up in certain indexed annuities, that's locked in and you're going to get an increasing income. Think about that, Neil. You get an increasing income on a decreasing asset. You can't do that with a stock portfolio.
Why is cash value life insurance so powerful in tax planning?
Well, first up, it can be tax deductible if set up properly, but it grows tax deferred, just like your 401k. Your distributions are tax free. That's absolutely huge. There's only 2 financial vehicles that I know of that are tax free. That's your Roth accounts, your Roth 401k, Roth IRA. And I have all kinds of people come up and tell me, well, municipal bonds and educational bonds are tax free. No, they're not. Because if you buy those in a state other than where you reside, you have state taxes. And if your state is large enough, you have estate taxes. And they both affect the taxation of Social Security and the means testing for Medicare Part B, which will be in the thousands of dollars per year. People do not understand that, and their CPAs and their attorneys and their financial planners aren't telling them about that. But cash value life insurance, Neil, protects you from lawsuits, liens, and judgments, and it avoids probate. Like I said, it eliminates or mitigates all the risk in retirement. In a stock portfolio only compounds.
And you know what? It's interesting when you talk about all this stuff because it blows me away. Because you said some people aren't planning it right with cash value life insurance to make it tax deferred and all those things. You have to run the right plan, right?
Exactly. It's like everything else. If you don't do correctly, you're going to have problems.
And you've seen it happen, haven't you?
Oh, I've seen it happen. That's why I have a team of people. Not everybody knows everything. I don't know it. I'm pretty good with life insurance and fixed indexed annuities. But when it comes to tax strategies, I have a team of specialists. And Neil, what I mean by that, let's say I'm your medical doctor. I can treat you for minor illnesses, minor injuries. But if you want your knee operated on, you want the orthopedic surgeon. He is the specialist. So that's what I have. I have tax-specific attorneys and CPA and other specialists on my team. And we collaborate together to come up with solutions for people's financial problems. 99% of the people out there only have your general practitioner doctor as then they're not specialized in it as their advisor.
How do annuities help reduce taxes?
Well, first off, they're tax deferred. They're guaranteed income. That's the big thing. And it's like I said, when you start taking money out, it's not about your rate of return in retirement. It's about distribution of your assets. Properly constructed fixed and fixed indexed annuities help. Well, it's been proven by Harvard study. If you have guaranteed income in retirement, you live a less stressful, happier, healthier, and longer life. And that's a fact. But people don't understand this because they'll all hear this crap from Kim Fisher and all these other. I hate all the news that shows you sent from my free report. Well, his report is full of crap as far as I'm concerned. He says he has safe investments. None of his investments are safe. But I can go on for that about an hour, but we don't have time for that.
So,
But
yeah. So what is the first move someone should make?
well, they can go to my website. I've got a ton of information in there, and I've got a tax calculator in there. You can see, put your money in, it's what your 401k, and you're going to see how much money you're going to pay in taxes. It's going to blow you away. People don't understand, like, in a 401k, 58% of people don't even think there's a fee on their 401k. A 1% fee over a 30-year period will reduce your income by 1/3. Okay. The average fee, Neil, get a hold of this. And this by Forbes magazine in the lap times is 2.99%. People are going to have less than half of their money, and then they're hit with taxes anywhere from 20 to over 55%. And people are not prepared for it.
All right. And the best place to go is strategicwealthstrategies.com. Or you can call them at 910-551-1046 or email strategicwealth, the number 0 @gmail.com. We appreciate it, Alan.
You betcha.
Thanks again. That was Strategic Wealth Strategies Podcast, guys.